So we're going to take a trip across the globe. It's an incredibly complex and dynamic economic environment that we find ourselves in here and that we found ourselves in for the past several years. So hopefully we can untangle some of the perceptions that are out there, give you a perspective of where we are in the economy, and also give you some confidence that regardless of whether we go into recession or not, that there's always opportunity in every market, okay? So the question that I get the most from clients is, are we going to go into recession? There's been a lot of talk about it throughout the past year, especially as the market was down so much in 2022. And there's a case to be made that, yeah, we're probably going to see a recession sometime over the next, call it 6 to 12 months. All a recession means is that you have a retrenchment of economic activity. Economic activity starts to recede, and we've had recessions since the birth of the country. It's nothing to be concerned about as an investor, because after every recession, we've had a rebirth of economic growth. And recessions are often a necessary part of the economic cycle, a cycle that we don't think is going to go away, really, ever. So what are the arguments to be made for what we call a soft landing, which means that the Fed is able to raise interest rates, and we're able to slow economic growth somewhat, but it doesn't contract. It doesn't put you into recession. There are a couple things going on. First, we have a very strong labor market. Now, labor market is necessary to a functioning economy because people have jobs, people have money, they want to go out and spend it, right? Part of the reason the job market has been so strong is that following the period post-COVID, we had a real supply and demand mismatch in the labor market. Well, why is that? Well, unfortunately, we had people that were unable to work or lost their lives because of COVID. You had people that were nearing or going to near retirement that decided, hey, I'm all done with going into communal workspace, so I'm gonna retire early. You had immigration that was really shut down. So very low levels of immigration over the past couple of years. And then finally, you had stimulus. There were a lot of workers, particularly younger workers, that were getting paid more to stay at home than to join the labor force. So very strong labor market. New construction, okay? New construction is a very positive thing for the economy. Why? Because when you buy a new house, well, first you gotta buy the land, right? Anyone built their own house, right? A couple people have built their own house. It's way more beneficial to the economy than selling an existing home because you have the land that's purchased, but then beyond that, you have the raw materials, you have the energy that goes into it, and you have the labor required to build that house. Because interest rates were so low, about 98% of homeowners in the United States that have a mortgage have it at 6% or below. Now, about 80% have it at 5% or below, and about 60% have it at 4% or below. So who wants to give up that type of mortgage? That's an asset on your household balance sheet. So people have been very reluctant to sell houses, but that's forced people into new construction, which again it's a tailwind for the economy. We've had a fiscal tailwind. Now, what is fiscal? That's just, we're near DC. Politicians love to spend. Fiscal spending is just government money that's going out into the economy. And we're really good at it in the United States. So the math that I use is that before COVID hit, the US economy, the GDP, gross domestic product, just all the goods and services all put together, was about a $21.5 trillion economy. So during COVID, we took about a $2 trillion hit to GDP, right? We decided to shut down the economy. But we filled it with a whole lot of stimulus. Anyone venture to guess the total number? I'll give you a hint. It's in the trillions. $5 trillion of direct fiscal stimulus that we shoved into a $2 trillion hole. So what happened to the other $3 trillion? Well, it went into people's savings. It went into cars, new homes, cryptocurrency, stocks, you name it. So the massive demand and the inflationary spark that we've had over the past couple of years can all, I think, be traced primarily back to the amount of fiscal stimulus on the backdrop of monetary stimulus that was already there. When we talk about monetary, it's just what the Federal Reserve does with interest rates. So that's the case for the soft landing, that we have sort of some economic slowdown, but we don't hit recession. Now, there's some equally good arguments to be made on the hard landing side of things. And the hard landing means that you go into recession, you have some sort of economic contraction, negative GDP growth. Tightening monetary policy. As I mentioned, we had 0 interest rates, essentially, right, following the financial crisis. And the Fed really struggled. They struggled to get it up to a normalized rate. COVID hits, they drop it down to 0. Again, very good for people buying cars, refinance their house, all accretive. But now that's all changed. So from essentially 0, we're up to 5.5%. And the Federal Reserve might not be done yet. So what does that mean? That means that mortgage rates now are north of 7.5%. It means to get a car loan, you're looking at anywhere between 8 and 10%, right? So when you increase interest rates like that, it contracts credit, it makes loans much more expensive to service. Inverted yield curve. This is kind of a wonky topic, but all we talk about when we're talking about a yield curve is what are treasury bonds yielding at different maturities, right? So if something's going to mature in a year, that means you get your principal back, you get the payments in between. If it's going to mature in 10 years, you get payments across that 10-year time period, you get your principal back at the end. So what are the yields at those different points in the curve? Now, you typically, and this makes sense, you have long-term yields that are higher than short-term yields. And it makes sense because it's much harder to see forward 10 years and see what kind of risks you're going to have to bear than it is to look forward for 1 year. So in normal conditions, you have an upward sloping yield curve, with those yields being higher the more time out you go. Now lately, we've had the opposite, where you have shorter term yields much higher than longer term yields. And what that is that's the bond market saying that 2 years out, we think yields are going to come down. So they're betting on the Federal Reserve to cut rates. Why would the Federal Reserve cut rates with inflation still too high? Well, they're going to cut rates because something happens in terms of a recessionary period, or there's some other sort of financial challenge in the economy. Negative LEIs. So there are 3 sort of categories of economic data that you can divide the world into from a statistical standpoint. You've got the trailing economic data, so that's gross domestic product, unemployment rate, all that stuff already happened. Then you've got coincident data that you get, which are things that are happening right now. And then finally, you have the leading economic indicators. What helps you see around corners? That's the leading economic indicators. And we're showing those going negative. And then finally, yes, we do have stimulus sort of on both areas. The stimulus I mentioned, that $5 trillion, pretty much spent down. On top of that, we have student loans that are going to kick in, or have kicked in, or will kick in rather on October 1st. And that student loan, just to give you some of the numbers behind it, it's about 40 million Americans that have some form of student loan outstanding. The average payment is somewhere between $250 and $350 per month. I don't know about you, but whenever I go out and have a situation where I don't have to pay a bill for a month, for example, when you buy a new car and they roll that first payment in, right, to your initial payment, I'm like, this is great. I've got an extra $600 in my pocket. So what do? You go spend it on something else. Well, the cohort of people that haven't had to pay their student loans for the past 3 years have not been sticking that money in their pockets. They've been spending it. So there's some studies that suggest that that cohort has increased their debt by as much as 10%. So to dig in a little bit more on the homeowner's situation and that reluctance to give up the rock bottom mortgages, let me just tell you a little bit what you're looking at here, because I recognize it looks a little bit like spaghetti. On the left-hand side, this chart that you see, this line right here, that's existing home sales. That's what happens when you move interest rates or mortgage rates from 3% to 7.5%. As I mentioned, though, this is new housing starts, new homes being built. So we're seeing this dynamic in real time take place. Now, the challenge with housing prices in the US, people have this asset, they don't want to give it up, right? But what about around the globe? If you're familiar how mortgage rates are structured in other parts of the world, We're super lucky in the US. We can lock in that 15-year, that 30-year mortgage, and we have a fixed payment. That fixed payment does not change if you have a fixed rate mortgage. But if you go to Canada, I was up there earlier this week, variable rate, it changes. UK, it changes. Australia, it changes. Right? So these all have mechanisms that somehow reset the mortgage. Some of them are actual floaters where they float on a sort of frequent basis, and some of them just have resets where every couple of years it gets reset to the next highest rate. So in contrast to US homeowners that have a mortgage, it's not quite the same asset on their balance sheet. So that's something to look out for, is some of the challenges around housing prices in other parts of the world. So another bright spot, though, that we see on the economic front, and I'm not a big fan of government spending, but every once in a while the government will do something, and you take a look at it and you say, well, this is brilliant. I'm surprised our government actually pulled this off. And that's the CHIPS and Science Act. Okay, and if you're familiar with that, it provides funding, it provides tax breaks, it decreases some of the regulatory burden for semiconductor chip, and quantum computer manufacturing in the United States, and several other ancillary related items. So why is this important? Well, this is important for several reasons. First of all, in the midst of COVID, and with the Russia invasion of Ukraine, I think we finally woke up and said, geez, we need to have a little bit more autonomy for national security purposes and also for our economy. If you remember what happened during COVID, the new cars, you could buy a used car, right? People were buying used cars that were more expensive than new cars. Why would anybody do that? Well, because they were supply constrained. Why were they supply constrained? Well, because as we've globalized over the past 4 decades, we have found ourselves ending up with supply chains stretched all across the globe, including through Ukraine. So you had a number of car manufacturers that couldn't get the semiconductor chips needed to create the cars, or to finish the cars. How many semiconductor chips need to be missing for a car to not be sold? 1. All right? And most cars have, especially the EVs, have to the tune potentially of a few hundred within their cars. So what happened here is the United States said, listen, for national security purposes, for purposes of our business, we need to provide a better environment to bring chip manufacturing back to the US. And that's exactly what they did. So as a result, you've seen manufacturing, construction spending just about double since that act was passed. So you're starting to see companies really make this investment. You saw it with Apple and Taiwan Semiconductor. They're opening up a chip plant in Arizona. Micron Technologies up in Syracuse, near my alma mater. They've committed $20 billion over the next 10 years to chips and high-tech manufacturing. So this is going to be a tailwind for the economy. And this is a really, really good thing. Now, on the other side, I talked about these leading economic indicators, these things that help you see around corners. And what do I mean by leading? How can they help you see around corners? Just going back to the housing example. So what do you need before you start building a house? You got to get a permit, right? So this composite of 10 different indicators, building permits. Consumer confidence. If you don't have a confident consumer, they're not going to spend money. That's also part of this. And if you go back to the 1960s, which is as far back as this data set goes, there's never been a period when you've gone minus 4% on this index series when you haven't had a recession. So this has been an indicator, look, we're going into some sort of economic slowdown. Again, I stress, this is part of the normal economic cycle. And every time you have a recession, you have a business cycle change, that creates opportunities. And if you go back and you look at every recession that has ever occurred in the United States in recent history, there's typically a catalyst. Now, the catalyst isn't the primary driver necessarily. There's a set of conditions that have taken place typically over a series of years. And the catalyst is that final grain of sand that falls on top and topples over the mountain. So if you think about the dot-com period, it was all of these overvalued tech companies, right? If you think about the global financial crisis, it was a housing bubble. So I think when history is written, we'll look back on what I think will be an economic slowdown, and we'll find that core inflation is the problem, and that was the catalyst. Because core inflation, or just inflation generally, is a tax on consumers, okay? $3.89. That's how much a gallon of gas costs when I came in here last night. I wasn't driving, I was in the cab, but I noticed the gas prices wherever I go. It's normal consumer behavior. You're reminded every half mile every time you pass a gas station. Food prices, another thing that you're reminded of on a daily, weekly basis. And core inflation is a tax in particular on those that are the lower income cohorts. It's a very politically unpopular thing to have high levels of inflation. Just ask Jimmy Carter. So where are we in inflation? So this is core inflation, so it just takes out food and energy, but it focuses on all the other stuff that we buy. We're way up here, okay? This is the Federal Reserve's target inflation of 2%. Now, why is it a 2% inflation target? Well, some inflation is good, right? Because if something is going to be a little bit more expensive in the future, you want to spend that money now. If you have deflation, which is falling inflation, which means that something that's $100 today is going to be, say, $95 in a year, what do? I'm going to wait a year and buy it then for 95 bucks. But that slows economies. That's what happened during the Great Depression, 1930s, and it was terrible for the economy. So nobody wants to go into a deflationary environment, but we want to have inflation that's modest. And the Federal Reserve decided 2%. Has anyone read the paper where the Fed puts the analysis together, where they talked about the 2% inflation target? Have you read any of the analysis? Well, I haven't either, and neither has the Fed, because they effectively pulled it out of thin air. They came to that 2% target using sort of this theoretical framework and just said, hey, want to have some inflation, but not too much. Let's throw out 2%. No reason it can't be 3%, and the economy actually grows stronger in periods of 3% inflation than in periods of 2% inflation. So they're just sort of trying to figure this out. Yes, sir?
What was inflation under Obama?
Under Obama, it was, it was higher. I don't have core PCE here off the top of my head, but during that period, it was running, say, 3%, right? Around 3%. And then we went into the financial crisis, though, inflation dropped, right? Because you have energy contraction, energy prices dropped, housing prices dropped, all of those things that go into that inflationary basket dropped. Okay. So, talking about the Federal Reserve again, and the reason I'm talking so much about it is because this interest rate trigger, this interest rate lever that is so critical, is even more critical in today's environment, because having moved the rates from 0 to 5.5% is having implications on the economy. And you'll see, again, going back to the mid-70s here, you had periods, let me explain a little bit more here before I make my comments. You had periods where you had the interest rate rising, right? These blue bars are recessionary periods. Another period here, interest rates rising by the Fed, recessionary period. Every single one of those periods from the 1970s, you've had the Fed going on pause, saying, okay, we've risen rates enough, we're going to hold here, and then in subsequent months, we've gone into recession. And here we are right here. Not sure if the Fed is fully done raising rates, but if they raise it, there's probably one more interest rate that's sort of inconsequential at this point. So it's just another thing to keep an eye out for, and another indication that we're getting closer. Now, why has the Fed been so aggressive? Right here. You look back to the 1970s, the rate went up, came back down. During this period, there was a gentleman named Arthur Burns, who was the chairman of the Federal Reserve, so here's the corollary to Jay Powell. Now, in the early 70s, you had three sort of bouts of inflation: early 70s, mid 70s, late 70s, early 80s. And Arthur Burns decided in the early 70s, well, inflation is not really a problem, even though it looks like a problem, because we've had this shortage, I kid you not, of anchovies, right? Which was making the price of livestock feed go up. They also had the Arab Spring, an increase in oil prices. That's also a problem, right? So what did he do? He said, let's take out oil, energy, and let's take out food prices. So they ended up with what you call core CPI. So it's just inflation less those two components. So then inflation came back with a vengeance, 1974. And I said, well, this isn't really a big thing. It's not a big deal. It's related to, for some reason, women's jewelry is getting expensive, and children's toys, and mobile homes. They've gotten really expensive too, so let's take those out. By the time Arthur Burns was done adjusting the CPI, the basket of goods that they used to measure inflation, taken out about 65% of that basket. All right? So that's when you start to hear the Fed talk about super core inflation and making all of these crazy modifications. So it is what it is. I think that the Fed is going to be pretty stoic and going to keep rates going for the next period of time. Now, I talked a little bit about yield curve and why it should be upward sloping. This is the other thing that we see, and the data bears out. During recessionary periods, so just to give you a lay of the land here, periods above the line when you have a normal upward sloping yield curve. Periods below the line when you have an inverted or negative sloped yield curve. So you can see it does a pretty good job right before recessions of showing an inversion. And in fact, this is pretty neat. In 2019, right here, we actually started to have an inverted yield curve. This was before COVID hit. The yield curve inverted. So we actually think that 2020 would have been a recession whether we had COVID or not. And COVID just exacerbated it. Now, it's not just when the yield curve inverts, but when it starts to normalize. It starts to slope back up when you're really close to recession. We've actually seen that from more than 1% inverted to about half of that now. So just another indicator that we could see a slowdown. So this is a further illustration here. The Fed tightening, what you see in the left-hand side on the red line is how quickly and how aggressively the Fed has moved up. We've kind of covered that already. Anybody heard of Silicon Valley Bank? Yeah, a lot, everybody. So when Silicon Valley Bank, I think for those that are not familiar with the story, they essentially had an asset liability mismatch. They had a very narrow base of customers that sort of all at once decided that they were going to pull their assets out of Silicon Valley Bank. The bank failed. There's another bank called Silvergate and Signature Bank that were facing similar issues. So in other periods of economic stress, the Fed would come in and they would say, okay, we're going to drop interest rates. Okay, we're going to make sure that we're going to soothe the system, provide credit, provide liquidity. They didn't do that. They didn't do that with Silicon Valley Bank. What they did is they provided a very specific lending program that said, listen, I know that your assets are impaired. They're below the value that you want them to be at, but put them on our balance sheet. We'll take care of it. You can hold them until they mature. So we had a lot of questions from clients saying, does this mean we're going into another global financial crisis? Is there risk of contagion? And at the time, we said, no, there's not a risk of contagion. We think this is a very different situation. We think it's isolated. Happy to say at the time that we were correct, right? But there's some knock-on effects that have occurred after the Silicon Valley Bank and other regional bank incidents. What's happened is you've seen credit growth decline. Because regional banks, which, by the way, provide most of the funding for commercial real estate, which isn't in great shape right now, the offices component at least isn't in great shape, they've said, okay, well, we don't want to have what happened to Silicon Valley Bank happen to us, so let's shore up our balance sheet. And by doing that, shoring up their balance sheet, one aspect of that is that they are going to lend a little bit less. So we've seen a decrease in credit growth. The other thing that's happened, and of my 3 kids, all 3 of them have said to me at various points in time, Dad, why did the bank just pay me 4 cents on my account, my savings account at the bank? And for a long time, people were happy to leave their cash at the bank because you couldn't get a yield, you couldn't get that much of a payment from any institution. Now that rates are higher, you can get it through CDs, money markets, Treasury Direct, lots of different places. So what people have started to do is pull their money out of banks and put it in those other places. Now, that's fine, right? That's fine for the investor because they can get a higher yield now. The reason it's not great for banks is that the banks don't have those assets to lend against now. So that also leads to sort of a contraction. China, second largest economy of the world. And they had a series of COVID restrictions that were lifted in April of this year. We really thought that this was going to provide a big boost to the global economic picture, and it just hasn't. So we think that the economy in China is weaker than many anticipated, including us at the beginning of this year. And China continues to be a force. They continue to be a force, and I think, will continue to be the second largest economy. But there's no longer the risk anytime in the near future that China is going to surpass the United States. Whereas you read the research 2 or 3 years ago, a lot of folks were saying, hey, in the next decade, China's going to edge out the United States. Don't think it's going to happen. Let's see if there are any more questions before I move on to stocks and bonds. Yes, sir?
I was going to say that the one thing I notice about China is I buy a lot of stuff like Amazon, and a lot of the stuff is coming from China, and it's junk.
Yep.
It doesn't last.
Yep.
It used to be when I was like growing up in 1950s, used to say everything made in Japan was junk in the 1950s. And my only point was that's what I don't like about China.
Yeah.
Like some of their products are not very good.
Yeah. So here's part of the story with China. If we go back 20 years ago, again, China had a very agrarian sort of culture and economic structure. And as they were able to take on more and more manufacturing, they joined the WTO in 2001. That was a big boom for them, taking on more manufacturing. As they took on more manufacturing, you had more people move into the cities. As more people moved into the cities, moved up to the middle class, wages needed to increase. Okay? So China is no longer the value in terms of the low-cost provider. And as a result, I think some of the quality of products may have suffered, right? Because they're still trying to manufacture this stuff and get the same profit for them, but they're having to pay higher wages, and they're also having to change some of the environmental practices that they've had in the past. Now, whether you like it or not, the truth is that a lot of US and European companies, when they outsourced to China, they just said, look, make me the widget, make me the product that I've asked you to make, and did so with less concern about the environmental impact, right? Also, the social impact and how the factors were treating workers. That's all very much changed. So in Europe now, there are some rules in place where you have to have a better understanding of how everyone in your supply chain is treating their employees and the environmental restrictions that they're following. So as a result, China's no longer going to be the low-cost provider. What that also does is that changes the bar in terms of re-globalization. So a good example is India. Okay? India is a friend of the US. They've got a highly educated population in pockets, not wholesale, but in pockets. They've got a much more favorable demographic profile than the United States. In fact, they've started to increase manufacturing of electronics products. They've doubled their export over the past year. So as things come out of China, we think that India is going to be a beneficiary of that. We also see countries that were sort of third in line outsourcers, like Vietnam, starting to make their move. So the US and Vietnam have just agreed to a trade pact where we're moving up in terms of where we sit on the trade relations scale with Vietnam. So I think China's facing a risk here of having quite a bit of their economy gutted out over the next decade. So let me take you first here, gentlemen.
I was really interested in your housing slide, and I wonder if you have a thought on why new housing starts are so much higher than are so high right now if existing home sales are dropping?
Yeah, because the homeowners, they just don't want to get rid of that mortgage. If I refinance right now, I get rid of a pretty nice mortgage rate, right?
Yeah, why are new housing starts up so much? It looked like there had been a recent uptick quite a bit.
Well, they're up because if I'm not going to move, there's no supply. So what we've seen happen is we've seen, and there's some other charts I don't have handy, but we've seen the supply drop off a cliff, right? Because without that inventory, people get frustrated. This is anecdotal, but I live about 30 miles south of Boston, and I received a little flyer from local realtor the other day. A year ago, there were 25 houses for sale in my town. Today, there are 5, because people are very reluctant. Even if they have to move, relocate, divorce, hey, maybe we can rent it out, because they don't want to give up that mortgage, going from a 3 to a 7.5%.
Where does the demand come?
The demand is coming because we never really rebuilt enough houses following the global financial crisis. So we've always been somewhat constricted in terms of inventory in the United States because home builders were so reluctant after what happened during the financial crisis. So, and I think we also have a dynamic of during COVID, you had people that might have been out in the home buying market that might have stayed at home. So I think this gentleman up here had a question.
Well, I was just going to go back to China. I mean, back in the mid-2000s, we were talking, in fact, we called it market Leninism, is what the Communist Party was running. But economists are saying you can't run an economy at 9 to 12%, which is what they were doing. They were artificially raising the price of the real, and so it's like burning out a motor. Now we're seeing finally what was predicted 15 years ago finally happened.
Yeah, sometimes economists do get some things right? Not often, but often they do. So, and that's exactly right. So some of the other aspects of the China situation that are scary is the property bubble, which they're trying to create sort of this controlled demolition. Most investors, private investors, invest in property. They won't invest in stocks and bonds. China. President Xi is becoming increasingly authoritarian and less predictable. So he's done things like all of a sudden you have folks like Jack Ma, these other Chinese business leaders that just kind of disappear, or they get pushed off into some other part of the country. We saw parts of the economy just get wholesale shut down, right? So President Xi said, we don't like what's going on with private education. We don't like what's going on with ride sharing. Just shut them down. So there's no due process. And the United States is a great place for investors because we have the rule of law, and it's well enforced for the most part relative to the rest of the globe. So, yes, sir.
There's 2 things going on in my mind right now that affect the future. One is there seems to be a growth in wage pressure with the unions and other workers as well. And also then the influx of AI and the impact on employment, wages, the whole thing. These are 2 big movements I see coming that it's kind of hard to predict, I think.
Yeah, I've got a couple anecdotes if I can for you here. And the comment was 2 things that are going to, just for the people in the back, 2 things that are really tricky to think about and hard to predict right now. Number 1, the demand for higher wages and what's going on with some of the union strikes right now. And the second is around AI. So the unions right now, as I think you're alluding to, you had UPS, you had the airline pilots, you've got UAW, and now you've got Kaiser Permanente, 75,000 healthcare workers taken to the picket lines. Wages have been growing at about a 6% annualized rate, right? And a lot of people feel that that's not enough, given some of the inflationary pressures, given some of the prices of homes. So there's a demand, and this is what happens in inflationary environments, is that people don't want to see their purchasing power eroded, so they start to demand higher wages. I'm going to tie this to technology, and maybe not AI, which is some of the technological changes are related. So any idea of the difference in components for an internal combustion vehicle versus an electric vehicle? It's about a 30% difference. 30% less components go into an EV. And I personally think that the UAW saw some of the writing on the wall here, and they said, we better strike while the iron's hot. We better demand our concessions now. There's other underpinnings behind that as well, but I think that that was really the catalyst and why they've been so aggressive in what their ask has been, right? So I do think that there is a risk of further wage pressures eroding into profit margins, especially when you have such low unemployment rates. So on the AI question, we think AI is incredibly transformative. We just don't know how yet. We think it's a really interesting technology, but it's unclear who the winners are going to be at the end of the day and who the losers are going to be. There's a lot of hype around AI. I don't think it's going to wholesale take jobs away from people right off the bat, but over time, as we see how it's implemented, there could be pockets of the economy that fall victim to AI. So actually, we saw, my colleague Victor and I were driving today, and Victor, I think we counted maybe 6 construction workers staring at each other, 2 of which were just holding signs up. And Victor said, have you seen there are automatic signs now that pop up, right? You know, there are these automated signs. I mean, if you go drive through the New Hampshire toll roads up in New England, there's still someone taking your buck from you instead of having, you know, just the picture by plate or whatever the mechanism is they have now. So, we'll see how it impacts the labor force, but I do think it does have an impact. Sir?
Barriers for permitting have been recognized as a major problem for reindustrialization, to the point that even President Biden has appointed Podesta as to stimulate that problem. Yeah. But is there really a chance to eliminate 4 years for permitting for electrical grids when the laws allow and encourage great detail and allowance for challenges to any new project?
Yeah, so the question around permitting for the electrical grid. So I think this transition, this green transition, is going to take place over time, okay? I don't think it's going to happen as quickly as the governments think it's going to happen. I don't think that we're going to see the transition over to a reformed electrical grid or to electric vehicles nearly as quickly as I think some of the politicians think. Now, it's politically popular to talk about this transition, right? But in terms of the actual execution, it's much more complex than that. So I think it's something that they're going to make earnest efforts at, but it's not going to be as easy as they think.
Would you liken that to a coal to gas transition?
Yeah, it's really hard to transition from coal to gas, and you have to look no further than Germany. So Germany made this transition very quickly to green energy. And if you remember, this goes back to fall of 2021, where there were a lot of concerns around energy and what was going on. There was a shortage. I'm sorry, this is fall of 2022. So when Germany made that transition to green energy, they primarily did it through wind farms and solar panels. So anyone guess what they don't have a lot of in Germany? Sun and wind, right? So what they've actually done is they've actually started using coal factories, right? So I think that transition is going to be much more difficult for sure. And by the way, we can do all we want in the United States to conserve energy and to make that transition. It's much harder for emerging market countries to do so. And a lot of emerging market countries are looking to us saying, hey, you guys had your industrial revolution 100 years ago, and you guys weren't thinking about the economy or pollution or anything, or about ecosystems or pollution or anything like that. So now is our chance, and you're trying to hold us back. So it's really tricky with some of these emerging economies. I think long-term energy solutions have to include nuclear as an option, and they're making some pretty good strides on nuclear. They actually have some nuclear power plants now that can be sort of broken down into components and then rebuilt. So it's not nearly as dangerous as it was. People concerned about things like Fukushima. Any other questions before I move on? You guys have good questions. All right. So I'm going to skip over a few slides here just in the interest of time to make sure that we get through some of our views on the stock and bond markets. We're facing one of the most concentrated stock markets that we've seen in the United States ever, really. So where else is there opportunity? We think outside the United States there's tremendous opportunity. So from an opportunity set, when you look at all of the global equities, all of the public traded companies in the world, you've got about 35% of those that are outside US borders. So on the left-hand side here, we took a look going back to 1970, and we said, okay, let's look at returns. Who did better? Actually, international equities did better than US equities over that entire time period. The challenge is that there are periods here, like you had in the 90s, like you had most recently, when international equities underperform US equities by a decent amount. But that doesn't mean that you shouldn't have them in your portfolio, because just when you think that they're not going to turn is when they tend to turn. In addition, I'll say that the valuation, so just looking at PEs as a measure of valuation, all that is to say, over the past 100 years, the average PE of the US stock market has been about 15.5 times earnings. That just means that investors will pay $15.5 for every dollar of earnings, okay? And you can compare, as a way to measure value, how the S&P is looking relative to the EFA. The EFA here is around 13, S&P around 19. Way higher, so you're not getting as much value in the US market. By the way, if you like dividends, the MSCI EFA, that overall developed market index outside the United States, has about a 3.5% dividend yield versus the US, which is about 1.7. So we also like the fact that there's an underallocation here relative to US in technology. You can see here, so this is US equities, international developed equities. Bigger allocation to industrial goods and services. Oh, and by the way, that reindustrialization that I talked about for the United States, that could happen in Europe too, because Europe has outsourced quite a bit to China. Healthcare here, and financials. So, you can see at the bottom there, US markets have 3 times the exposure to technology. So I'm going to wrap up here in just a minute. I do want to talk about fixed income, because this is a tremendous opportunity, and we think it's going to be a tremendous opportunity for the next several years. Fixed income investors have been starved for yield, right? Really over the past decade, they have been starved. And as painful as 2022 was, and I'll show you a slide on that in a second, we've passed that point where we think there's going to be further pain inflicted on fixed income markets to that extent. And you can see here that we've broken out of this channel that we're in. You can get risk-free return now for 4.75% now in US Treasury bonds. If you add in a little bit of exposure through a mutual fund to credit or companies that are issuing debt, you can get an even higher yield. So we think we're going into a structurally higher inflationary and interest rate environment, which is actually going to be a pretty good thing for bonds as long as inflation doesn't turn into runaway inflation. So this is how it looks when you take a look at the Treasury versus credit spreads. Now, I'll try to break this down and simplify it here. All we did is take a look at the core bonds. This is a broad-based basket of bonds for US investors, very common. If you go back here to April of 2020, you can see that these two components were almost 50-50. This right here is Treasury yield. That's what you get from buying the US Treasury. Really zero risk there. This is the credit spread in dark blue. And again, what that credit spread is that means that if you're going to lend money to a company like an Apple, you're going to demand just a little bit more yield. If you're going to lend money to a company that, say, is a wildcat driller looking for oil, you're going to want a lot more yield because there's a lot more risk. So the point of this is that investing in fixed income today, you have this tremendous amount of underlying risk-free yield that you can achieve as an investor, you can earn as an investor. So we're really favorable to bonds over stocks right now. I'm going to talk quickly about 2022, and then we're going to wrap things up. To tell you what we have here on the vertical axis here, we have equity returns. On the horizontal, we've got bond returns. Okay, and this looks at calendar years, so year-over-year returns for each of them. And what we find is that most of the years, going back to 1972, end up in this positive quadrant. So you've got both positive bond returns and positive equity returns. Pretty good, right? And that's why these asset allocation portfolios work so well, is sometimes the bonds are better than stocks, sometimes stocks are better than bonds, but they have a diversifying effect. Well, because we had interest rates and inflation that moved so quickly, not just the level, but the speed at which they achieved the level, you ended up down here in 2022. And that's part of the reason that it felt so painful. No matter what asset class you were invested in, you felt a lot of pain in 2022. Now, the good news is we think that this is, and we can see here, it's a relatively rare event. We don't think we're going to see a repeat of that. So as painful as 2022 was, investors have a way of employing what's called recency bias, which means that whatever happened most recently, they think it's going to happen in the future. And it's human nature. I think everyone has some element of it. If it's been raining for 4 days straight, you probably think it's going to rain tomorrow too, right? But markets are different. We don't think this is going to be a repeat of 2022 into 2023 or 2024, or likely beyond that. Who knows for sure? But we are encouraged that you're going to have a much more positive outlook, particularly on the fixed income side going forward. So just to wrap things up here, our base case is that we do have some sort of recession. Again, don't get freaked out about it. It's just part of the normal economic cycle, normal business cycle. Think about all of the tough times we've been through over the past, decade and beyond, and we've still had very strong returns in equity markets. Markets are very concentrated within large cap growth, but we think there's opportunity within both value in the US and international equities, which tend to be more oriented towards value. High quality fixed income, so you think about municipal bonds, think about high quality corporate bonds, really, really tremendous value now. And remember, when you buy a corporate bond, you get that underlying treasury yield, plus you get an additional spread up above and beyond that. And finally, the balanced portfolio, where a lot of investors start thinking about 60% equities and 40% bonds. Didn't work out well in 2022, but we think it's set to recalibrate. So we think the future looks bright. We think that the value of professional advice is higher now than it probably ever has been in the past few decades. So with that, I'll close, and thank you for your time.